started? Okay.
We're all set.
How do I get behind this?
So, thank you for the opportunity to come out and visit with you again. I know some of you, I met when I was here a few months ago. You said it was a year ago. I came out and talked about the watchdogs. And I'm really glad that you gave me the opportunity to put that presentation together because we used it a couple of times after that. So thank you.
Great.
You were the test crowd, so it worked. So, as she told you, I have recently left my position as CEO of the Alliance of Arizona Nonprofits after 10 years. It was not an easy decision to leave, something that I'm so passionate about, though I know that it will be soon in very capable hands as far as the new CEO is concerned. And currently, it's in the very capable hands of the Board of Directors, the Board of Trustees, which is very pertinent to our topic today. We'll kind of get to that a little bit, not to that particular, but why what they're experiencing now is ultimately what all of our boards are responsible for. But I was drawn to this new cause, something I believe passionately about, that ultimately hopefully will change the way public policy is made in the state of Arizona, the way our politics work. And I've been railing about it for years, and I said if I didn't do something about it, I either had to shut up or leave or something, because I was tired of hearing myself talking about it, not doing anything about it. And if you think about it, that's what we all do in nonprofits. And it's the organization I work for is a nonprofit. It's a 501c4 nonprofit. We're a nonprofit organization. And that's what we do. We are passionate about a cause. We believe in something in the community that we think needs to change, improve, or just be supported and maintained. And we go to work on it. And those of us who are staff in the nonprofit sector, it is our chosen profession in one fashion or another. But ultimately, our organizations get formed, and that sort of trust in the passion is held by our boards of directors. Even in cases where you have a founder, okay, and I guess that's what they called me at the Alliance, although I always kind of rejected that label because technically I was the second CEO, though I was on the founding board, so I guess I kind of had to accept it. But there were so many people involved in getting us started when we launched that it always just felt wrong to claim this title of founder. But whatever, at some point you just have to accept it. And so whenever you have a founder, oftentimes people want to sort of say that's their organization. And in fact, it's not. It never is. As much as they may think it is, as much as they want it to be, as much as we all give them the label, at the end of the day, it is an organization that really belongs to the community, and the people responsible to make sure that it stays where it belongs is the board. So I say that as kind of preface to everything we're going to talk about today. It's a perspective. It's important to have when you're thinking about issues with your board. Sometime years ago, my Alliance work, we did a workshop down in Yuma. I had a very talented local consultant, long time, actually founder of her organization, as a matter of fact, before she left to do consulting, who traveled with me to do the workshop, so we kind of co-presented. And there was a moment in the workshop where it was actually about fundraising, but where there was just this, one of those learning moments. Those of you in the education field know you get those learning moments. It's not in the lesson plan, right? But this is what people want to hear about. And it was about the board's involvement in fundraising. And so they just kind of riffed for like an hour and a half on this, right? Kind of blew up the entire agenda, but that's what people want to know. So we're driving back and we're debriefing that. And she said, this is the consultant now, saying, who's just made given wise counsel about the board's role in fundraising. So clearly she gets it. And she said, why do we have a board of directors anyway? Why do we have a board? Well, Stephanie, it's because, no, I know the reason that we do, but why do we, Because sometimes there's so much work. I could spend that time doing something else that would advance the organization faster, farther. So we had this, it's a 4-hour drive from Yuma, so we had a long chat about this, and we didn't solve anything. But I've always remembered that conversation because, you know, there are times when it does seem like this role of the board, this engagement of the board, sort of all these things we go through with our boards, you know, there's this question, why? Why do we have to go through this? Well, I said that I just recently left my organization. They don't yet have a replacement for me at the Alliance. Right now, the board chair is in charge. That's why. There has to be somebody that holds this organization in trust, and it is the board. So what you're going to hear today are some things about what this means in terms of the legal responsibilities of the board, their fiduciary responsibilities, and then maybe some tips for how we can help them fully embrace that part of their role. This is a topic that is very easy to do in any audience because I heard reference earlier to small organization, large organization. This applies to every organization, no matter how large or small, whether it's all volunteer or a staff of 400. Same issues. As far as the IRS is concerned, which is to a large degree the governing sort of body of law here, we're all the same. We are nonprofits. And of course, everything I'm going to talk about today pertains to a 501c3 charitable nonprofit, although a lot of this also applies to any other category of nonprofit, but there are some specific things to C3s that we'll just assume, because I think everybody in here is a C3, that that's what we're talking about. So these are the 4 things we're going to talk about. I want to begin, and by the way, you have a handout there if you want to take notes on it. It kind of follows the outline of the PowerPoint. I guess everybody except for our person who's watching from video land. I'm happy to send this along too if you want to send it out.
Okay.
So let's first of all talk about what this board, I sort of described a moment ago, the board. There's actually a definition that I use for boards. And this is training, by the way, or some of this content in this training. We actually do for people who want to be on boards. We have a program called Arizona Board at the Alliance that is primarily designed for somebody who's never been on a board, and this isn't a comprehensive training. This isn't everything you need to know to be a great board member, but it's a way to sort of find out what you're getting yourself into before you commit. And in fact, one of my favorite parts of that training is we arm them with 4 pages of questions. That 3 pages or 1 page is actually questions they ask themselves about whether they're really ready for this, and then 3 questions they ask the nonprofit before they join. So anyway, so just so you know, we actually consider this first part I'm doing so fundamental to everybody's understanding of governance and their role in a nonprofit that we put it into training for people who aren't even yet on a board. This would be part of board training. This is also part of our Nonprofit 101 training. I mean, it kind of goes everywhere. And it begins actually with a definition. And I don't have these words up here, but forgot to put that slide in. So there's a definition of a board that's really important to understand what they are. A board is, or a board member is, a steward of the mission of a nonprofit organization on behalf of the community. The 3 key words there are steward, mission, and community. They each are chosen very carefully. I'm going to do them actually in reverse order now. Community. And you're a charitable nonprofit. You are formed for the benefit of the community. Yes, you may have particular services that benefit children, the homeless, seniors, the environment. Okay, you may have a particular part of the community you're addressing, but the community as a whole has an interest in your doing your work for that population, for that part of our community. That's why we exist. That's why you're granted charitable status by the IRS, because you're deemed to have a charitable benefit, and by charitable we mean it's kind of for everyone. It also means, by the way, just so you know, nobody owns the nonprofit. That's why you don't have the founder like you have in a for-profit business that is actually the owner. The founder's never an owner. That's what I meant by you aren't really, it's not your nonprofit. It's owned by the community. Actually, nobody. Technically, there's no legal definition of who actually owns the nonprofit. That's why the board becomes so important. But kind of in lieu of formal legal ownership, we say kind of the community owns it. And so we're accountable to the community. So every one of us, in Arizona there are 15,000 charitable nonprofits. Every one of us is a co-owner of each of those 15,000 charitable nonprofits. Have you been keeping track? Have you been paying attention? You've got a lot of entities you're owning there, right? So that's the idea. So the community first part. Second word, going in reverse order, the mission. Now, we all know, we're mission-driven organizations, how important our mission is. I mean, for-profit companies write mission statements as well, but in a nonprofit, they are the central nature of who we are. So you notice I said that the boards are stewards of the mission, not just the organization. I didn't say they're stewards of the organization. I said they're stewards of the mission. If I had time, which I don't, I would tell you a story about a nonprofit on whose board I sat, where our board had to deal with some very challenging issues financially, ultimately led to merger with another organization, although that took quite a while. But at the time that we were going through this, the question was, how can we keep kind of the organization staffed? And if we had focused on the stuff of the organization instead of the mission of the organization, I don't think it would have survived. I don't think there was a model left that would have kept the stuff as it had existed for about 20 years together. It was called Kids Voting Arizona. Anybody heard of Kids Voting Arizona? Well, hopefully you're still hearing Kids Voting Arizona, because every 2 years, starting in 1988, kids have had the opportunity to vote in an election just like with the same ballot that their parents do. Okay, basically the same ballot. Okay, that was started in 1988. When we were dealing with these very challenging issues and I was on the board, it was 20 years later. And we stayed focused on the mission, and every 2 years, still, kids are voting in Kids Voting Arizona. Now it's actually run by the Arizona Foundation for Legal Services and Education. We took ourselves ultimately out of the equation as the board. I'm on an advisory board, right? Because we knew that if we tried to just keep the organization alive, we'd lose the mission. And I remember at the time, the CEO of the Foundation for Legal Services and Education, as we were launching that partnership that ultimately led to the merger, saying, I'm just in awe of you as board members staying so focused on the mission. I thought, well, what else are we supposed to do? But apparently that's not necessarily real common. People will get focused on, and we had to let a CEO go in the middle of all that. We had to let an office go, right? So people sometimes get focused on this stuff. It's about the mission. And then the word steward. Anybody know what steward means? What the definition of steward is? Like Webster's? Yeah, nobody really does. It could mean, it's not the guy to ship, although actually that is one of the definitions, but that's not the one I'm using. A steward actually means when you are responsible for, you're a caretaker for resources that do not belong to you. And so now that you kind of understand this essence of a nonprofit, it totally makes sense why we would use that word. That's the board. So with that come these 4 basic functions. I give you that context because it's going to make it real easy for me to move through each one of these together. The organic function, the strategic function, the fiduciary function, and staffing. Let's begin with the organic function. We literally mean it is only a board of directors that can create a nonprofit that is responsible for its assets. That is never something that's a responsibility of the staff. When it comes to the assets of the organization, remember I said there are no real owners, so it's up to that board as the stewards to manage those assets. And then if the day arrives and you do dissolve that nonprofit, whether it's through merger, the example I just gave, or just shutting it down, it is only the board that can do that. Staff can't do any of these things. This is all board. This is part of their organic function. Second, the strategic function. Now this is one you're probably more familiar with. It's important for a board to think strategically, be setting the strategy for the organization. This is where you begin to get into kind of the fundraising role, right? The board should be responsible for ensuring that there is a sustainable business model for the organization. What do I mean by business model? So I use that word very intentionally. We oftentimes think that's only a for-profit term, but we need one as well, which is literally what are the resources required to serve the mission, and how are you going to have those resources year after year to sustain that mission? What's your model for doing that? A financial model, business model, whatever you want to call it. That's the board's responsibility to make sure that exists. Sometimes we convert that to a fundraising responsibility. Is this our 20-minute mark? I call it that because I said in Arizona we have 15,000 charitable nonprofits. A majority of them do not have any paid staff. So in that case, who are the staff? Probably the board members. Okay, so I call it organizing the work, right? Now when you get to the point where you actually are going to have paid staff, usually you will start with some form of CEO, executive, whatever you call them, whatever the first staff is. You hire that person, you evaluate that person, you can fire that person. And then and the model should be that they hire, fire, evaluate all the other staff in the organization. But basically this idea of however you organize the work at the staffing level, the board has that responsibility. So those are the four basic functions. That kind of lays the foundation. And again, no matter how large or small, every one of these applies. So let's now get into the legal issues. And by the way, doing okay on time. I'm using material that actually, the next two segments combined are about 2.5 hours, so I've compressed it. So I certainly welcome questions, and we can get into some dialogue, but also to keep on my time, we may have to say, that could be another workshop for another day, and I could recommend people to come out and give that. So we're going to talk about 5 sort of things in the legal issues. Sort of the legal duties of a board, business judgment, some threats that you should be looking out for, protecting yourself against those threats, and then very specifically threats to tax exemption. So let's begin with duties. Oh, that's really hard to read, isn't it? So there are, in just about any course you take or anywhere you go where people who are experts in good governance for nonprofit boards, they are going to have some version of these 3 duties that every single board member, this is where we're really talking about each individual board member has these 3 duties. A duty of good faith, of loyalty, and of care. And they sound like motherhood and apple pie when you say them like that, but as we go through each one, you're going to understand why it's actually really important to state them and know them and the bearing that they're going to have on our legal frame. So let's begin with good faith. It really means honesty. Honesty of purpose, honesty in fact. Okay? Now, you can face liability, legal liability, if you know you have a duty to act and you intentionally or recklessly don't, or you know that something is not in the best interest of the nonprofit and you intentionally or recklessly do it anyway. So in other words, these sound like very dishonest things to do, right? A director will be liable to the corporation for damages arising out of any of these acts. Any intent to cause injury to the corporation with reckless disregard to the corporation's best interest. Now, again, that's, by the way, probably true for a director of any corporation anywhere, but remember my definition earlier. That's why I gave that to you. So you'd understand that when you're talking about good faith as a nonprofit board member, it is the best interest of the mission, it is the best interest of the community. That's what you're there for. Second, loyalty. Again, I know on the surface, these seem like really simple and basic concepts. So loyalty simply means that you take into account the best interests of the nonprofit, not your personal interests. Now we'll get into conflict of interest in a moment, but what about when you serve on multiple boards? Which is common, right? I mean, we all keep recruiting the same 5 people in Chandler, right? And so, I heard one person say one time that when he was at the corporation, And he said he considered his job, he was like in the community affairs, he considered his job basically be a professional board member. I think he said at one point he was on 32 boards.
Oh,
Yeah, that's what I said too. I fell out of my chair in the back of the room. Crazy. I don't know how anybody, I don't care even if you are, that is your job to go serve on boards. That's just, you can't do that. My personal recommendation always to individuals is never more than 3. Now, actual governing board. I mean, sometimes there are people, they say they're on a board, they're on like some advisory board or something like that. That's okay to add those, but a governing board with all the responsibilities that we're talking about today, how you could do more than 3, I don't know. And you better only be an officer of one of them at a time, particularly a chair. Okay. Well, there are situations that arise where if you are on multiple boards, you might actually have a difficult time dealing with the loyalty. I will tell you of one personal story on this. When we first launched the Alliance, how many of you have heard of the Organization for Nonprofit Executives? Okay. So a lot of people when we first started said, really, shouldn't both of your organizations kind of be one? Pardon the pun, they're called one, but anyway. And we were brand new, and they'd been around for, I don't know, whatever, about 6 years, I think, at that time. And so there were these merger talks. Well, I was on the board of one. And I'm now the paid employee, the first paid employee of the Alliance. And we were having these conversations, and it got pretty serious. Like they were, and I sat there thinking, I can't do this. There's nothing I say in this room that you will not take as having essentially a conflict, that I'm looking out for the people who are paying my salary.
Right.
Kind of, we all would tend to do that. So I resigned from the one board. Like, I can't be in these conversations in good conscience and maintain my loyalty pledge to the board member. Okay, so there are situations where this becomes important. Let me give you another story. Unfortunately, I can't name the organization for this one. This was right after the recession began. And there, of course, you remember what those days were like. The sky is falling, nonprofits were struggling. And there were 2 significant organizations doing essentially the same thing, but geographically different parts of the valley. And there was a discussion of whether they should be merged. And there were some very serious discussions. In fact, there were some major funders that were trying to make it happen. And they were pretty deep into those conversations when one of the board members of one of the organizations basically said, if this happens, and then my financial support disappears, and they were a major, major donor. And I got the call about this because it was from one of the foundations that was very much trying to make it happen, who was really wondering whether this was a conflict of interest for this board member. They were kind of throwing around their way. By the way, the merger failed. It didn't go through. It was influential enough that it didn't happen. And at least in the view of this one foundation, they believed that this was in the community's interest, and clearly this one donor was not acting in the community's interest. And but you can imagine the situation, right? They were really a very significant donor, a significant part of the financial support of the organization. So loyalty, it sounds like mother and apple pie, but man, you can really get into these situations where it can be challenging as a board. All right, and now there is care. Care. Sort of like what? You mean, do you care? Well, yeah, do you care? Do you care enough to show up? Do you care enough to read what they send you? How many of you have board members that always read everything you send them? Oh, I know board members that are, I'm sorry. You don't have to.
She does.
Yeah, you always do, yay! We found one in the valley.
We got him.
Now everybody's going to recruit you. It is your responsibility as a board member to pay attention, to be involved. I will just give you one example, and I won't even say anything about the name of the organization. Fiesta.
You don't have to say anything about that.
And they're going to come up a couple more times in my presentation, so I will say more later. So it's just imperative. I know it's sort of like really? Like, it's that important that I'm at the meeting? Yes, it's important that you're at the meeting. Yes, it's important when I email you and say, have you read through that and I need your feedback on it, that I actually get something. And I will tell you, the nonprofit executives I know, that I hear from all the time, say that doesn't, it's way too often that doesn't happen. Again, this seems like a very simple idea. Honestly, this may be the hardest one that our board members have. And this is why that what I call the days of letterhead board members are over. If somebody's on your board because of their name and you just want it on the letterhead, find another way. Use them another way, put them on an advisory board, do something else. But my gosh, you cannot be a letterhead board member and exercise this duty. And you have that responsibility. Because by the way, when we get into these other legal issues, these apply to every one of you. It's not, like, hey, I was a letterhead board member, I didn't count. Yes, are you on the legal documents as a board member? You're just as accountable as anybody else. Here's the business judgment rule. This is what the lawyers are basically looking at. And this is the business judgment rule in Arizona. One thing to note, we'll get into a couple examples of this later on some things. There is a lot of the governance issues, these sort of corporate governance issues that are actually guided by state law, state corporation law, as opposed to certain things that are governed because we're 501c3 nonprofits by the IRS. So I know sometimes people say, oh, we just look to the IRS for all that. Well, some of these governance things, some of these things that get into, like where you can get into legal issues, they're actually state corporation laws. Now, in Arizona, we happen to have fairly flexible, fairly easy to follow corporation rules. Some states will have much more stringent ones. But in this case, this is actually the Arizona law here. So a director is not liable for any action taken as a director or for any failure to take any action if the director acted in compliance with his or her fiduciary responsibilities. If basically you exhibited a duty of care, a duty of loyalty, and a duty of good faith, if you are doing those three things, you should be fairly protected. You're acting in the best interest of the organization. You're paying attention to the information given to you. You're asking questions. You're making every attempt to do the right thing. You're actually going to be in fairly good shape legally. Can you get sued? Of course. Anybody get sued for anything. But you should have a good defense. And that's what you want. And that's why everything that goes on in that boardroom, you should be thinking about this business judgment rule. That's why the duty of care. It's like, I don't get why when people go, oh, I don't know, I didn't really pay attention to that. Really? Fiesta Bowl. Okay, so
That's true.
let's get to a couple of threats. Conflict of interest. Who can tell me what a conflict of interest is in a nonprofit board?
If someone is receiving personal gain from the organization that they happen to be sitting on.
And they can't do that, right?
Right.
Nope, you're wrong.
Well, they can't do, or let me rephrase that. They have to disclose
Thank you.
that there is a conflict of interest.
Thank
And if it's a very large one, like to do with the budget or something, they would exclude from voting or whatever, so.
Actually, just about anything they should exclude.
Yeah.
But yeah, so thank you. I'm sorry to set you.
No, that's okay. I knew what I was going to say, but I knew you were going to catch it.
It is true that people out there have this idea that we can't have conflicts of interest with our nonprofit boards. And it's not the case that we can't have a conflict. It's how we handle the conflict that matters. Okay? So that is why when you complete your IRS Form 990 and there's that section with just like check boxes of do you have this, do you have this, do you have this, do you have this, this long list, right? And one of them is you have a conflict of interest policy. You check yes. What that means is you have a policy for how you handle conflicts of interest. That's what that says. Now let me actually tell a brief story of a recent case that we dealt with at the Alliance kind of through the media that is disturbing on many levels, and we'll get to the heart of it when you have a real conflict of interest. So I got a call from a reporter in November about an organization actually started with an understanding that we were talking about a union, which is a 501c5 organization, although many of these rules apply to them as well. But ultimately, it turns out they have a companion 501c3. It's called the Police Officers of Scottsdale Association, so that would be the police officer union for Scottsdale Police. And then they have a companion 501c3 called, Police Officers is called POSA. And then their companion 501c3 is POSA Outreach. And POSA Outreach does basically two things. They have two main things anyway. They have a program of read with a cop, so the cops go out to the schools and read to the kids. And then at Christmas time, they have shop with a cop, where they go out, underprivileged kids and buy gifts for them. Very common thing. You see this all over. Very good thing. Class of police officers giving back to the community. Wonderful thing. Well, the reporter was calling me because they were trying to figure out the 990s of both of these organizations. Because there were all these sort of intertwined things. And I won't get into the whole story, but the essence of the story was that the union had hired a telemarketing firm to do the fundraising for the Shop with a Cop and Read with a Cop programs. And according to the most recent 990, which I think was 2012, they had raised nearly $1 million. And as far as this reporter could tell, ultimately only about $40,000 of that was being spent on the Read with a Cop and Shop with a Cop programs. Okay, now what was going on, of course, is the telemarketing outfit was taking about $850,000 in their fees. Yes, 85% of the take, pretty high. And then about $150,000 was then going to the union. About some portion of which, I got the numbers now, stayed with the union, basically supported their executive director. And then the rest went over to the 501c3, although it was a little bit hard to tell exactly how it got there. It wasn't that transparent in the reporting. And the 501c3, which by the way happened to have the same executive director, so she got paid by both organizations. And then, once you actually got to the actual program expenses for the two programs, they ended up being about $40,000. Now, by the way, could just be really fuzzy reporting, but there was also this little bit of an issue with the fact that the chairman of the board of the union happened to be married to the executive director of both the C5 and the C3. And, but remember, it's okay. You can have a conflict of interest like that, as long as you have a policy that deals with, except inexplicably, the 501c3 of both organizations said they had no conflict of interest policy. Now, after doing the first interview, that was before it got on Channel 12, and I had to go on camera and talk the next week. This was a KJAZ reporter who called me at first. I hadn't even checked to see, over the top. Okay, so when I say you can have conflicts of interest, not like that, okay? What I mean is, let's say you have a board member who you're putting on an event, and they happen to have a catering company, and maybe you're suddenly having to put on this event and you don't have time to do a very thorough process of finding the best caterer, and they say they can do it, and they'll do it for a song or whatever, right? That's okay, you can do that. Just make sure that you disclose it all. They recuse themselves from the vote. They stay out of the conversation. They let the rest of the board exercise their business judgment in an arm's length transaction to make the decision. That's acceptable. Now, what I would suggest to you is try to avoid those still, though, when you can. Like, don't say you have your insurance agent you've been using for a long time and then you want to put them on the board. I'm always uncomfortable about like core vendors that you use on a regular basis being on the board. It's much harder. It's one thing if the one-shot thing, like for a catering kind of for an event, when it's a core business that you rely upon and you create a board seat for that person, I think it's harder to argue that you don't have some kind of conflict ongoing there. So that's really what you want to be looking for. And remember with disclosure, and there are so many good samples out there, policies, and by the way, a lot of this has come about since Sarbanes-Oxley 2001 federal legislation dealing with all corporations Actually, this is the only one that applies to nonprofits. There are a lot of other things that they did in governance practices for for-profit companies, and they didn't actually apply them to nonprofits, except for this one. So conflict of interest policy, you do need to have in place. So let's move to the next one. Oversight. So this gets to this idea of the duty of care, right? It is never acceptable to say, I didn't know. It's literally, again, I'm going to go back to FIASCO. I told they were going to, they just gave us so much material, to work with. I actually used them as a case study when I was teaching at ASU, right after it all happened. The board members basically trusted their CEO. They just trusted him to just do the right thing all the time, and they never verified. So the simple, remember the old, with the Russians, right? Trust but verify, Ronald Reagan, that's how, trust but verify. That's kind of what you're talking about. You need to have accountability mechanisms for your staff built in. So it is. I could get into a lot of, there's a lot of mechanisms. You have to mention conflict of interest policy, compensation policies in terms of how people are getting paid, travel and reimbursement policies, or how they're being reimbursed, whistleblower policies. Here's another one that's on the IRS 990. Now keep in mind, with that IRS 990, there's a lot of those things on there. You check yes or no. It doesn't mean that they're legally required. It just means that if you say no, you're immediately raising a question in a donor's mind or somebody who's looking at that 990. Why wouldn't they have a whistleblower policy? What are they worried about? Right? So these are simple things to do. We just make sure you have them in place. But then also use them, exercise them, make sure your staff knows them. That's a protection for the staff to be able to ultimately deal with somebody they feel is not acting in the best faith of the organization. Now the other thing we have to deal with, we can talk about staff, but we also talk about committees here. So this is always sort of, there's a tension here, right? So obviously you can't have everything go through the board. In fact, you shouldn't have everything go through the board. One of my least favorite moments at the Alliance would be, and this happened more than once, and it would always be with a small organization, which I found back, the dues were $85 a year. And they would say, well, we will consider joining the Alliance, but we'll have to take that to our board. An $85 membership you have to take to your board? Like, really? You need our help. Please join, you need our help. So, of course, we don't expect everything, including this little membership due to go through the board. And that, some of that, again, when you're staffed, of course, you delegate a lot to the staff. But when it comes to the main functions of the board, those 4 functions we talked about at the very beginning today, you also can't, to exercise them, you don't necessarily have enough time in your board meetings. You also have committees. So you delegate things to committees. Well, what you need to be very clear about is what you're delegating to a committee. You're delegating some of the detail work, but if you're going to the essence of something you have responsibility for in the power of the board, you want to make sure that you're just delegating kind of the work, not the power, because the power still rests with you at the board level. Example, your 990, your 98, well, that's the end part, but your 990 in your audit. If you're doing an audit or financial review or whatever you're doing. You do your audit, you have an audit committee, and I'm not going to get into the whole audit finance committee thing and all that kind of stuff. There's some things you should do around that, but we'll just call it the audit committee right now. You have an audit committee. They're going to work with the auditor, they're going to do all this work on it, and you should have an audit committee. That's the best practice. But the final review of the audit, the final sort of presentation by the auditor of the audit should go to the full board. And every board member should be participating and asking questions. There should also be a moment where the staff is asked to leave the room so that the board can ask questions of the auditor without staff there at all. That is a board responsibility. You cannot delegate that power. You do not want to delegate that power. Let me just give you one example. I can't name this organization either, unfortunately, but you would know the name if I told you that it wasn't a big organization, but it had been around a very, very long time and had a long-time executive director. And the executive director and the board just trusted the treasurer to make sure that all the auditing and the filing of the 990 was done properly every year. And somehow, and there had been a series of treasurers, but there was one sort of period of time where they had one treasurer for 3 or 4 years. And they woke up one day and learned that they had lost their tax exemption from the IRS. Because they had just simply trusted the treasurer to do it right, and they hadn't. Nobody had, there had been no review. I mean, I was in shock when I learned of it, because again, they had a long-time executive director. I just wouldn't have expected to have allowed this, but quite frankly, she was negligent in her duties as a non-voting member of that board, in not making sure that they verified that everything that was being done with that 9 years was done correct. It took them 2 years to get their tax. There was nothing actually wrong. They didn't really do anything wrong, except they just screwed up with the IRS. They just had to kind of, and then they had to go through lots of time to prove that, you know, they didn't do anything wrong. And I mean, why would you ever want to get in that situation? So never just leave it all to somebody you trust. Verify, verify, verify. Now, we of course know there are some protections for these things. One of them is insurance. How many of you know that your organization has D&O insurance? How many of you do not know that your organization has D&O insurance? All right, good. Well, you're covered here. That's good. Every organization should have D&O insurance. It's simple. Directors and officers insurance. For these governance things we're talking about, for these fiduciary responsibilities, this is sort of a minimal, essential way to ensure that beyond that business judgment rule, you've got some additional protection. And insurance can help indemnify you against certain kinds of things. Not against everything. There's a lot of things that it does not cover. But for basic governance functions that provide you some protection. I will not serve on a board unless they have D&O insurance. I always ask whether they have D&O insurance. I was once asked to serve on a board where they said they didn't, and actually, well, I should say, they said they didn't know what was D&O insurance. I explained it to them. They called me back and said, we don't have it, but thank you, we're getting it. And then I was at the meeting where they were both voting on me and voting on the D&O insurance in the same meeting. And in that meeting, the executive director tried to convince them not to buy the D&O insurance. And they all looked at me and I'm like, you're not voting me in if you don't do this. And so they voted it, and yeah, about 3 months later, we were finding ourselves an executive director. I mean, for other reasons, it wasn't just that. But, so D&O is a basic protection that every board member should want. I don't have time to get into a lot of details of this, plus I'm not the best one to go into a lot of details about what is and isn't covered in D&O, but it is basic protection that every nonprofit board should have. And then there is what I consider the most important protection. It's called discipline. It's simple. It's the discipline of, if you're a board member, asking questions. It's the discipline, if you're the board chair, of making sure that everybody is actively participating, not letting people slide. It is the discipline of being awake and involved. And if you have a board member who isn't, have a conversation about whether they should continue on the board. And I just think it's that simple. And we are nice people in the nonprofit sector. We don't like doing that sometimes. But it's always paving a path to something going awry when we don't have that discipline. And that's your best protection. Now let's talk about 4 specific threats to tax exemption. I'm going to go through these relatively rapidly because these get into really heavy-duty legal issues, and I'm not a lawyer. But these are the 4 biggies. These are basically the 4 most common ways nonprofits lose their tax exemption. First is private inurement excess benefit. We talked about this earlier under the conflict of interest. This applies to directors and trustees. It applies to officers. It applies to substantial contributors. It applies to key employees and to family members of everybody that I just mentioned. Go into the frequently asked questions at IRS to look at what constitutes a family member, because there's a lot of specifics about that. Also, if you have businesses affiliated with you, this can apply to them, or, and this is the catch-all they have in the statute, anybody with substantial influence on the organization. What is this? What is it that applies to all these? You cannot get an excess benefit from the organization. This organization isn't created for you. You're not a shareholder. You're not an owner. If you have a business that collaborates, you're not there fundamentally just to get business and the most business you can out of it. You're there to support the mission of the organization. I mean, you can do that in a business relationship, So let me give you an example of how we applied this at the Alliance. At the Alliance, many of you know, if your organizations are members, most of your organizations are members, that we have vendor partners, right? That you can get a discount of some kind if you're a member of the Alliance. We have to be very careful what we do at the Alliance about promoting those businesses. Because if we basically turn ourselves into nothing but a shill for all these for-profit businesses, we risk, and by the way, especially if we get any kind of financial benefit back, which some of our vendors, we actually do get something. We get a rebate back from Waste Office products for the purchases of our members. Well, if we turn into the biggest cheerleader for office supply buying on the planet, you know, one begins to wonder whether, you know, we're really doing this for a different benefit. So these are things you have to think about in all of your business partnerships. Obviously, your board members need to be cognizant of, and your staff as well. That's why you have compensation policies. People say, well, what about staff? I mean, I've literally had people say, well, I don't get it. I mean, people are getting paid. Isn't that a private inurement? It's not an excess benefit. You're paying people. How good are our salaries in general, right? Yeah. You're like, oh yeah, I'm getting paid like 3 times what I get for something, right? No, there's not an excess benefit. But there are cases where it happens, right? So, now let's talk about unrelated business activity. How many know what unrelated business income is in a nonprofit? Do you have any? How many have unrelated business income?
Okay, well, yeah.
So you file and you pay taxes on it?
Oh,
No.
No, then you don't, okay.
Got
So
it.
unrelated business income. Here's another thing that a lot of people don't know. You can actually have a profit-making activity in a nonprofit and make profit on it and pay taxes on it,
Yay.
okay? Now, if it becomes like really big and sort of takes over everything you're doing, then you have the potential of losing your tax exemption, and that's where this happens. Remember, this is threats to tax exemption. So this is where, if you go too far with it, you actually lose your tax exemption. Most famous example of this, how many have heard of Children's Television Workshop? A nonprofit organization that started creating wonderfully educationally sound programming for children, and there was this one program called Sesame Street. And then Sesame Street kind of got big, and then they started merchandising, and then Sesame Street became more about the merchandising than about children. But it was all originally income to Children's Television Workshop. At some point, the IRS said, no, you got to spin off all of that merchandising stuff into a for-profit company. So there is still Children's Television Workshop, I think. I think the last time I checked, they still exist. They have kind of a much more, Sesame Street is basically a for-profit entity. So unrelated business activity is allowed, it just can't end up dwarfing your mission. And if you have any, you pay taxes on it, and that's okay. Okay, you won't pay taxes on your overall income, but just that part is considered unrelated business activity. All right, and then there's political campaign activities. How many know the rules on this one? What can you do, what can you not do? What can you not do as a nonprofit?
Endorse.
Endorse candidates, use any resources to support candidates, give campaign contributions to candidates, Fiesta Bowl. Is Fiesta Bowl still a nonprofit?
Yeah,
Yeah.
amazing.
So unless John McCain, and by the way, this is Patrick's opinion, make this really clear. Unless John McCain is going to intervene to make sure that you don't lose your tax exemption, pretty much what I think happened to the Fiesta Bowl. Because believe me, folks, they reimburse their employees making thousands and thousands of dollars of campaign contributions. This is one of the most over-the-line things a nonprofit has done. They're a 501c3 nonprofit. That a 501c3 nonprofit has done in this area, and and they did not lose their tax. They paid some fines, they did some things, but they didn't lose their tax exemption. This is one that supposedly now, if you're a little nonprofit and you do this, you're going to lose.
Okay.
Now, I do a whole separate workshop just on this topic alone, so I won't get into all that. There's a lot of things that you can do that are ancillary to. There are ways that you can sort of, you can do voter outreach and voter registration, a lot of things you can do, but you can't cross that bright line that we have as C3 nonprofits in actually supporting or opposing candidates. And then there's excessive lobbying. Now this one I always hesitate to put up here because there's so much misinformation out there. So I just want to be really clear. You can lobby. In fact, you should lobby. Please do. Okay, you are working on issues. You know, what did we just fall to 41st in per capita income in Arizona? We've dropped from 35th to 41st. That's making your jobs really, really hard in social services. Like, you should be lobbying on these issues. You should be educating the public. Okay, so understand that's where I normally come from. Okay? Because I'm doing my legal responsibility workshop, I have to tell you that if you do violate the rules, because there are some limits to how much lobbying you can do, this can lead to losing your tax exemption. And I won't get into what all the limits are because I got 5 minutes left and I'm going to have a few more things I got to talk about. All right. Let's just quickly go through these. I was only going to touch on these briefly anyway because I know a lot of finance staff on here and you know all the basics of this. But I'm emphasizing in here that, yes, when you have finance staff that take care of a lot of things for you, that's good. That's a great support to have as a board. You don't kind of have to do it yourself. I've been working with a small theater up in the Northwest Valley that has, their accounting is done by one of their board members because they can't afford. They do have a bookkeeper, that's a paid bookkeeper, but she kind of does all the financial reports and all that. So it's wonderful when you have staff, you have the resources to have either a contractor or staff do it for you, but it does not absolve you of the responsibility to make sure that all of the accounting processes are there that you should have, that all the rules, that you're following GASB, that you're following all the nonprofits permutations of GASB. It is still your responsibility as a board to make sure this is done right. This is one of the hardest things for small, and you said you just got your C3 status with your nonprofit. This is one of the hardest things for a new nonprofit because there's a lot of work to get this right. And if you don't do it right, a lot of bad things can happen. That theater that I just mentioned a moment ago, they started out, when they first started out, they had a pro bono accountant who helped them. Wow, wonderful. I like to do that. They didn't know nonprofit accounting. They thought you only had to file a 990